Hello, my name is Matthew Granger and this is the FCTO Weekly Review and Outlook for the week of July the 23rd, 2012. The euro remained broadly pressured last week and fresh selling was seen towards the end of the week on the back of renewed concerns in Spain. Spanish 10-year yields closed above 7.2%, which was a clear reflection on the market's lack of confidence despite all the efforts by European leaders. Risk appetite was originally solid on corporate earnings and sent the Dow to as high as 12,977 and boosted the Aussie, Kiwi and Loonie against the dollar. And the contrast in sentiments could be seen with the Euro Aussie dollar and Euro Canadian dollar dropping to new record lows. However, equity markets were then dragged down by Eurozone worries and sent the high beta currencies lower. After all, the overall developments in the markets remained unchanged. Equities could still try to make another high, cautiously on expectation on more easing from major central banks, even though the path would be bumpy. The Aussie and to a lesser extent Canadian and sterling would benefit most from risk rallies, whilst the euro will definitely lag behind. Eurozone concerns will be the major driver that sets risks back. In those cases, the common currency would continue to be sold off. The dollar and yen would be stuck mixed, with the yen with an uncertain upper hand. So selling the Euro Aussie dollar, Euro Canadian dollar, Euro New Zealand dollar, and to a lesser extent Euro sterling would remain the strategy that has the clearer higher odds. Some late developments in the Eurozone should be noted. Spain said on Friday that the GDP will contract by 0.5% in 2013, a sharp downward revision from prior projection of a 0.2% growth. The 2012 projection was revised slightly up from -1.7% to -1.5%. Nonetheless, the data means Spain will remain in recession at least until the end of 2013. Also, Valencia's, Spain's most indebted region, sought help under the €18 billion programme passed on Thursday. The act reflected the fact that Spain's regions are suffering from the liquidity shortage in the markets and more are expected to come. The negative news overshadowed the fact that Eurozone finance ministers approved the terms of the €100 billion bailout for Spanish banks. Spanish 10-year yields closed at 7.267% and broke above June's highs. It should be noted again that 7% is seen by markets as an unsustainable level that eventually led to the national bailout of Greece, Ireland and Portugal. So the situation in Spain is getting more dangerous now. Other negative news was that the European Central Bank said on Friday that it would reject Greek government bonds as collateral for its lending operations. The ECB said it would revisit the eligibility of Greek bonds only after Troika concluded their reviews on Greece's progress in austerities and reforms. Another development to note is that even since the ECB cut the benchmark interest rates to a historical low of 0.75% and deposit rates to 0% on July the 5th, the Euro interbank offered rate continued to dive. The 3-month bank-to-bank lending rate dropped to a new record low of 0.51% on Friday. That's the first time it dropped below the 3-month dollar LIBOR since 2008, which fixed at 0.451% on Friday. That's based on market expectations that more rate cuts could be seen from the ECB in the future. Indeed, the ECB Executive Board member Quarre said that the negative rates are an option. In the US, the Fed Chairman Ben Bernanke's semi-annual testimony was another disappointment. Bernanke noted that the US economy has continued to recover, but activity appears to have decelerated somewhat during the first half of this year. He also said that a fall in the unemployment rate would be frustratingly slow. He described that recent data had a generally disappointing tone and warned that the so-called fiscal cliff could push the US bank into a shallow recession early next year. He urged Congress to work to address the nation's fiscal challenges in a way that takes into account both the need for long-run sustainability and the fragility of the recovery. Meanwhile, Bernanke also warned that the possibility of worsening in Europe remains a significant risk to the outlook. He pledged that the Fed is prepared to take further action as appropriate to promote a stronger economic recovery, but fell short of hinting when and what additional stimulus would be implemented. The Bank of England minutes for the July 4th to July 5th meeting revealed that the MPC voted unanimously to keep rates unchanged at 0.5%. However, the vote for expanding the asset purchase programme by £50 billion was not unanimous but by 7-2. Spencer Dale and Ben Broadbent preferred to keep the size unchanged. Nonetheless, policy members felt that the case for additional stimulus was compelling and stronger than at the previous meeting, as there were increasing signs that the threat of a disorderly resolution of the financial tensions in the euro area was affecting growth at home. The minutes noted that inflation has moderated faster than projected in May's quarterly inflation report due to reduction in global energy prices, and all members of the committee judged that further economic stimulus was required in order to meet the inflation targets in the medium term. Meanwhile, the impact of the funding for lending scheme and other policy initiatives might alter the committee's assessment of the effectiveness of further rate cuts and would be reviewed accordingly. That is, rate cuts are back on the radar in MPC's mind. The Bank of Canada kept rates unchanged at 1% as widely expected. The bank maintained a tightening bias and said that to the extent that the economic expansion continues and the current excess supply in the economy is gradually absorbed, some modest withdrawal of the present considerable monetary policy stimulus may become appropriate. However, the bank did lower growth forecast to 2.1% in 2012 and 2.3% in 2013. Compared to prior forecasts of 2.4% for both years. Core inflation is expected to remain around 2% over the projection horizon, while total CPI is expected to remain noticeably below the 2% target over the coming year before returning to target around mid-2013. The Reserve Bank of Australia's minutes struck a less dovish tone and lowered the chance of another rate cut in August. The bank noted that with material easing in monetary policy having occurred over the preceding 6 months or so, and with recent signs that the domestic economy had a little more momentum than had been earlier indicated, members saw no need for any further adjustments to the cash rate at this meeting. The IMF lowered global growth forecast for 2012 and 2013 to 3.5% and 3.9%, down from prior projections of 3.5% and 4.1% respectively. The IMF noted that the largest single risk to global growth is associated with a potential escalation of the crisis in Europe. It hailed the outcome of last month's EU summit as a step in the right direction, but also urged that progress on banking and fiscal union must be a priority for political leaders. They also warned that if the US could not deal with the so-called fiscal cliff, there could be an enormous shock to the US as well as other advanced economies. The IMF urged the ECB to provide further defences against an escalation of the crisis. It said in a report that the measures could include policies to support demand in the short run and fend off downside risks to inflation, as well as measures to ensure monetary transmission currently impaired by financial stress in some countries. Also, the ECB should be given explicit responsibility for financial stability and full lender of last resort functions. The ECB could also cut rates from the current historical low of 0.75%, plus buy a representative portfolio of long-term government bonds. And that's it. For more detailed analysis and daily updates on all the news affecting the Forex market, join us throughout the week at www.forexcurrencytradingonline.co.uk. That's www.forexcurrencytradingonline.co.uk.